just wait. Gold is the first shoe to drop. Gold soaring like this is telling you that the dollar is going to go down, that bonds are going to go down. If you wait for that, if you wait for the move in gold to also be reflected in a big down move in the dollar and a down move in the bond market, well, you're too late. You're too late to diffuse the crisis, but you're also too late to prepare for it financially. That's why I keep, reiterating with my clients, look, you got to buy gold, you got to buy silver, hey, you got to dip now to 4,100, or, I think 4,000 is really the new 3,000 for gold. So 4,000 is kind of the support. Doesn't mean we can't go below it, but I think any dip below 4,000 will be short-lived. Silver got up to 54 and change, so it took out the 50 double top. We're back below 50 now. I mean, silver is a lot more volatile.
The rally in gold is driven more by panic than by price. Economist Peter Schiff, the founder of Euro-Pacific Asset Management, believes that we are in the early stages of a worldwide decline in trust in the US currency. The central banks of the world are getting ready for a future in which American debt is no longer the center of the financial system. Investors are quietly realizing that the Fed cannot combat inflation and fund Washington's expenditures at the same time as deficits skyrocket and interest expenses eat up the budget. Schiff cautions that every significant currency crisis starts out slowly before erupting all at once. Gold is rising because people are becoming more realistic, not because of speculation. The dollar will suffer when the markets eventually demand honesty, because the US economy is based on borrowed time and borrowed money. Don't forget to like, subscribe, and ring the bell for the latest analysis on gold and silver markets.
The bottom line is Peter, are you concerned about another regional banking crisis right now, or is it just a case of a few banks mismanaging their loan books?
Well, I'm more concerned about a U.S. dollar and sovereign debt crisis, because I think that's going to be the consequence of the Fed bailing out all these banks and preventing that. The Fed does these stress tests every year, and I always point out that the stress tests are all BS, because they don't stress test for stagflation. They don't have any scenario in which they test how a bank would perform with stagflation. So if we had a recession with rising inflation and rising interest rates, they don't test any banks for that. And I think that's because they know they would all fail. And so they don't even want to run a test if they already know that no one's going to pass. But that is the environment that we're in, and it's going to get a lot worse. And I think the only way that we're not going to see widespread failure in the banking system is if we have massive money printing. And so that's going to ultimately cause a dollar and sovereign debt crisis. And again, that is what gold is telling you. Gold is the monetary canary in the coal mine. Gold is shooting up now for a reason. To me, it's very much like the collapse of subprime in 2007, because I had been forecasting subprime to collapse for years before it did. But I forecast that as part of a broader banking crisis, financial crisis, that I knew would follow the collapse of the subprime market, which would ultimately take down the mortgage market and the banking system and Freddie and Fannie. And I've been talking about that and warning about that. I wrote about it. But when the subprime market blew up in 2007, the mainstream dismissed it as an isolated event. Even the Federal Reserve said, don't worry, it's contained. And I was out there saying, no, it's not. It's the tip of this huge iceberg. Just wait. And of course, we had the crisis the following year in 2008. Well, to me, I've been warning about a big move up in the price of gold as foreshadowing a dollar crisis and a sovereign debt crisis, and now it's happening. And just like the mainstream dismissed the warning from subprime, they're dismissing the warning from gold. But I think gold is just indicating that a much bigger crisis is coming. And I've even heard people say that we don't have to worry about the price of gold because the dollar's not falling, because the bond market isn't falling. And so therefore, gold's rise is not reflective of a loss of confidence in the dollar or the bond market. And my response to that is just wait. Gold is the first shoe to drop. Gold soaring like this is telling you that the dollar is going to go down, that bonds are going to go down. If you wait for that, if you wait for the move in gold to also be reflected in a big down move in the dollar and a down move in the bond market, well, you're too late. You're too late to diffuse the crisis, but you're also too late to prepare for it financially. That's why I keep reiterating with my clients, look, you got to buy gold, you got to buy silver. hey, you got to dip now to 4,100, or, I think 4,000 is really the new 3,000 for gold. So 4,000 is kind of the support. Doesn't mean we can't go below it, but I think any dip below 4,000 will be short-lived. Silver got up to 54 and change, so it took out the 50 double top. We're back below 50 now. I mean, silver is a lot more volatile. You don't have the central bank buying to stabilize it like you do in gold. But look, I think silver has clearly broken out. It's proven that 50 isn't a ceiling anymore. Soon it's going to be the floor. People should be buying silver. I think it's very cheap. And people should be getting out of U.S. assets. I think the U.S. stock market, which has been really in a massive bear market for 25 years, I think that bear market is going to accelerate. But finally, after many, many years, foreign markets are smoking U.S. markets. I think the S&P is up maybe 13, 14% this year. I've got a foreign dividend payer fund that's up almost 50% this year. This isn't my gold fund. This is just my defensive dividend paying stock fund. But so foreign markets are finally way outperforming the U.S. And I think that trend is going to continue. It's not just central bankers who are getting out of dollars into gold. It's foreign investors who are going to be getting out of U.S. investments and reinvesting domestically. That's going to be followed by Americans diversifying internationally. Gold is rising as a reflection of a loss of confidence in the dollar, because I think the main reason that gold is being accumulated is because central banks have lost confidence in the dollar and in the fiscal responsibility of the U.S. government, or the credibility of the Federal Reserve. So you're seeing it first in gold. I think you'll next see it in the dollar, and then I think you'll see it after that in the Treasury market, where you'll start to see a big drop in bond prices and a rise in long-term yields, despite the fact that the Fed is going to be reducing short-term rates. And I think that is going to be the catalyst for a return to quantitative easing, because I think the Fed is going to try to lower long-term interest rates through its open market operations, where it needs to print money to buy the bonds that the rest of the world is selling. And so that, I think, will be another catalyst to drive gold to even higher levels, because that's just massive inflation. And, the last couple of times we tried a QE, inflation, at least the way the government purports to measure it, was below 2%. So the government was able to justify QE by saying, look, inflation is below target. And so we could do this because the goal is to get inflation higher to reach our target. And so, we're going to accomplish that with QE. But if inflation is already well above 2%, what is the excuse for creating more inflation? How do you justify QE when inflation is 4 or 5%?
That's
the way
simple,
the government
Peter.
measures it.
The US dollar is being significantly replaced by gold in the global financial system. A historic shift in the global monetary order is beginning as central banks all over the world are quickly building up their gold reserves. The dollar's position as the world's reserve currency permitted the US to spend far more than it could afford for decades. However, this privilege is currently diminishing. Instead of relying on US budgetary restraint, nations like China are shifting toward a more stable, gold-backed reserve mechanism that is based on actual, tangible wealth. What is driving current gold rally is what makes it different from previous ones. This has nothing to do with retail hype or short-term speculation. While the actual accumulation takes place covertly within central banks, institutional investors continue to exercise caution. Due to new trade agreements, reserve diversification, and the gradual decline of the dollar in international settlements, the dollar's credibility crisis is no longer a remote threat. The rise of gold is more than just a commerce. It serves as the real-time basis for the upcoming monetary system. Show some love by hitting the like button, subscribing to the channel, and turning on notifications. Now, let's get back and hear his following words.
China is buying to have gold as a reserve to replace the dollar. And I think that's what a lot of other central banks are doing. They're buying gold to restore gold as, the monetary backing of their currency. And this, I think, is a major, transformation in the global monetary system. I think it's on the order of, or maybe bigger than what happened in the 1970s when we went off the gold standard. And so the world went from having the U.S. dollar backed by gold as the reserve to just having a fiat currency as the reserve. That was a significant shift in the monetary order. But now it's not the U.S. going off the gold standard. It's the world going off the dollar standard and returning to the gold standard. And I think that's probably even more significant, certainly for the United States, because we're about to have the rug pulled out from under us. And, we've been living off of the dollar's reserve status. We've used it as a crutch to live beyond our means. We've enjoyed lower consumer prices and lower interest rates and higher asset prices as a result of this privilege that I think we are in the process of losing. So when you point to these other moves up in gold and silver, I think they were largely driven at the peaks by speculators, by retail investors who were, jumping on the bandwagon and pushing the markets to, kind of extreme points, and then they would go down. I don't think we've even seen that yet. I think that retail investors have barely participated. In fact, if you look back at the flows from all of last year and most of this year, retail investors were selling gold ETFs. They were selling gold stock ETFs. So they sold into the rally. They weren't buying. In fact, if you talk to a lot of the smaller coin shops around the country, and I've seen interviews, most of the people that came in over the last few months were people that were selling their gold. They were like bringing in their jewelry to melt it down and get some cash. It wasn't a frenzy of people looking to buy gold. And the institutions, are barely involved. The pension funds, the endowments, hedge funds, they barely have any position in gold. It wasn't until just recently that you saw, more talk from, Ray Dalio although Jeff Gundlach has been talking gold for a while, but a few other people. Morgan Stanley came out in the last month. I think one of their analysts said that we should tweak the 60-40 portfolio to be 60-20-20, where you split your bonds in half and you buy gold. But I doubt they've had any opportunity to make the switch. They've just started to recognize gold's value after denying it for decades. I've been in the investment business for, over 35 years, and I was pretty much a lone voice, as a stockbroker, telling my clients that they should have an allocation to gold in their portfolio. And, when I went on major financial networks to talk about it, they generally laughed at me, or they accused me of fear mongering or just trying to sell gold. They didn't accuse a stockbroker of recommending a stock because he's just trying to sell stocks. And of course, I was both, right? I was a stockbroker, but I also thought that people should have gold as part of their portfolios. But that was sacrilegious. But now people are starting to say, hey, wait a minute, given the fact that gold has outperformed stocks over the last 25 years, if you go back to 1999, when the Dow peaked at 45 ounces of gold, today it's worth, it was 11. I didn't do the math today, but it was, just recently down to 11. That was a 70% decline in the price of the Dow Jones measured in real money, measured in gold. And given the fact that just holding gold, in a shoebox beat the Dow. And I'm not talking about just the price. It actually beat the return because the dividend yield has been pretty low over these years. You actually did better just holding a gold coin. And so I guess, given that, I think Wall Street finally recognizes that, yes, gold has a place in your portfolio. And if that's the case, well, this rally has a long way to go because that means a lot of investors have a lot of gold they need to buy. Meanwhile, the central banks are getting started. I don't think they're nearly complete in their transformation of their reserves. They still have a lot of dollars to get rid of and a lot of gold to buy.
According to Peter Schiff, a significant monetary revolution is about to commence, one that may equal or perhaps exceed the demise of the gold standard in the 70s. He argues that in order to construct a solid foundation for their currencies, nations like China and many other central banks are purchasing gold rather than stockpiling US dollars. According to Schiff, this signifies the world's transition from a dollar-backed world to a gold-backed world. The United States has benefited from the dollar's reserve currency status for many years, including reduced consumer prices, easier borrowing, and higher asset values. He notes that, in contrast to earlier gold rallies fueled by retail speculation, institutional and retail involvement is still quite low this time. While central banks and a few progressive funds are progressively amassing gold ETFs, the majority of ordinary investors have been selling them rather than purchasing them. Thus, the actual migration hasn't yet started. Schiff contends that a significant reallocation is imminent as more institutions acknowledge gold's long-term superiority, having outperformed the Dow over the last 25 years even after dividends. He claims that central banks are only beginning to make the shift from holding far too many dollars and not enough gold. The US fiscal picture is unsustainable, Schiff cautions. The Federal Reserve is under pressure to lower interest rates despite rising prices because the government can no longer afford interest rates that reflect inflation. This policy trap informs foreign creditors that owning treasury bonds ensures that losses will be repaid in dollars, which are becoming less valuable annually. Naturally, governments will decide to hold gold rather than depreciating paper promises when confidence declines. Thanks for watching. If you like this video, give it a thumbs up, subscribe, and turn on post notifications so you never miss an update.